Welcome everybody for today's webinar. We're going to be talking about multifamily tax benefits, insider secrets that you do not want to miss. There are a lot of things that each investors, especially multifamily passive investors, need to know, or definitely good to know so that you can save on taxes. And we'll go through that in a short while. So just want to introduce myself. My name is James Kandasamy. Can I get my slides to go? Okay, I'm from with Achieve Investment Group. We are a private equity firm focusing on raising money from busy high net individual to buy, manage, and hold multifamily assets to deliver above average returns on their investments. Currently, we own approximately 1,000 units with 6 different properties with control of more than $65 million in assets. That's really not including our passive investments. We won San Antonio Apartment Association Best Property Turnaround of the Year. And we do this investor educational series on a regular basis. Every few months we do this. And my main objective to do this is to make sure that passive investors that works with me and any other investors that work with other sponsors or syndicators are knowledgeable, because knowledgeable investors will be a very valuable asset to everybody, right? So without further ado, I'm gonna pass the share to Nick. Hello, us. Nick, why not introduce yourself and start sharing your screen?
Hi, everybody. My name is Nick Holevis. I'm a CPA. I'm licensed in Illinois, but I live in Texas at the moment. And I've been involved in both real estate investing and doing tax work and accounting work for many investors all over the country. And let me get my screen up here.
And one reminder is for any questions, you can use the chat box for questions, and we want to limit the questions to the end of the webinar so that we can be done on time with the presentation and we can just tackle the questions at the end. So please continue typing your questions on the chat box. Okay. Go ahead, Nick.
I have with me Marie Dansu. She's my business partner. She's in Chicago area. And we've both been, I used to work for her actually a long time ago. And then, so we partnered up a few years ago and started a whole tax group. And we mainly focus on real estate investors and entrepreneurs in general. That's our main clientele. And we've been doing it now for 4 years together. So, and I've also been involved with another tax firm in the past, Lifetime Tax Advisors. I was with them for right around the same time. So, but I continued this partnership going with Marie. So that's a little bit of my background. I currently invest in multifamily investments with my IRA, and I also invest in single-family homes. I do a lot of Airbnb. In Michigan, I currently have 4 units up there. At one point, I had about 221 apartments and houses on my own. Unfortunately, with the crash, I got to learn a very big lesson on getting over leveraged. So, so since then, I've been able to, come back and, reinvest in real estate. I always feel it's the best area to invest in, especially in the United States. So, because there are so many advantages. And there's a little bit, okay. This is our little disclaimer. So this presentation is for educational purposes only and is not to be construed as legal, tax, or other professional advice. Any tax advice contained in this presentation was not intended or written to be used and cannot be used by the recipient for the purposes of avoiding penalties that may be imposed under the Internal Revenue Code or applicable state or local tax law provisions. Before using any tax advice contained in this presentation, taxpayers should seek advice based on the taxpayer's particular circumstances from an independent tax advisors. We always have to read this, so before I start a presentation, just FYI. So. Here we go. And so our goal for today is to have an improved understanding about how the real estate, how taxes and real estate investments work together, implement some tools and strategies, and then the importance of, planning and keeping organized with all your paperwork, your receipts, things like that. There's the agenda, we're going to talk about the different types of taxes that exist, anywhere from property taxes to income taxes, state income taxes, and all of that if it applies to you. Good record keeping, gains and losses on sale of assets, about being a real estate professional or broker dealer, some tax saving strategies. We're also going to talk about Trump's Tax Cuts and Jobs Act of 2017. And then at the end, we're going to talk about some self-directed IRAs with UBIT and UDFI. UBIT is unrelated business income tax, and UDFI is unrelated debt financed income. So why should you care? Because, knowledge equals saving money. The more you know about how to invest, the better. Whether you're a passive investor or a lead or, actively investing in real estate for yourself, there are things that you should know. Just in general. Also, you need to be, if you're current with your finances at all times, you're also saving a lot of money. And then if you create a good system on how everything is done, you also save a lot of money in the end, especially on the tax side of things. Okay, getting started. Choosing a business entity. As a sole proprietor, you can just go ahead and purchase any of the any apartment buildings or single family houses or anything like that you want. That's very easy. You just put your name on it. It's very simple record keeping. You don't have to have as much reporting like you do with an LLC or an S Corp. I would probably suggest getting, a good liability insurance for all the properties, but you will be subjected to 15.3 self-employment tax if you are actively fixing and flipping properties, or if you're wholesaling properties or anything like that. As a passive, if you're buying a property that's just a rental, the 15.3% does not apply to you. It's also the biggest tax bill because everything just goes straight through to your personal. And the passive income advantages, like I said. So the passive income is when you purchase a property, have a property manager manage it, and then they take, you just collect whatever's left over each month. LLC. An LLC is either a disregarded entity or a partnership with somebody else. Or you can also have it taxed as an S Corp as well. There's different ways to do it, but it's a limited liability. It's very flexible. It's less than corporation paperwork, but you can also elect how you want to be taxed. You could either be a single member LLC, where everything, once again, goes straight through to your personal. So it's kind of like being a sole proprietor. It's just that you have a legal entity to separate you from the properties that you purchase. As a partnership, it's, you get together with a few other people. Like James puts together all these multifamily deals. Those are all partnership deals, and they're all on a Form 1065. They're usually through an LLC. So you have the partners that get together and purchase put the equity in. The general partner basically pretty much has all the risk. The KPs have, the loan risks as well, So they can be structured very differently on the partnership side. Also, an LLC could be taxed as an S Corp or a C Corp. So an S Corp is, I would probably suggest it more on the fix and flip, wholesaling side, brokerage side, things like that. If you're property management, something that creates an income. But also under the Trump tax plan, it might be more advantageous to do the C Corp because it went from 35 to 21%. So there's different ways to how the LLC can be taxed. Now, if you have an S Corp or a C Corp, you got liability protection. So you and the entity are basically separate. So, however, you have a lot of corporate record keeping that you got to do. So make sure that you have all your mileage. Make sure that you have all your documents, your annual reports are filed on time. Make sure you file your tax returns on time because they're filed on March 15th versus April 15th for the personal side. As an S corp or a C corp, it's a lot less flexible than the partnership. So under a partnership, you can elect, how much income can go to each partner if you so choose to, after you have a meeting. However, the S corp, you can only do it based on the percentage of ownership. And the C corp as well. And the S corp and C corp are very good for active real estate activities, and those are your fix and flips, the wholesaling, the assignments, some. I would even probably put like the brokerage stuff in there too. So I mean, that's probably your best bet if your state allows it. I know in the state of Texas, there's like some things that you can't just be. You got to be a broker and above in order to be able to do that. And you have to give yourself a reasonable wage as well. So you got to file a W-2 every year. You have to file your 941s every quarter, where you pay all the taxes to the federal and if it applies to you, the state as well. And then you got the self-directed IRA.
Hey, Nick, I have a question. So for passive multifamily investors, so are you saying it's good to create an LLC and invest through an LLC? Because I see a lot of investors invest using their personal name.
Right. So if it's a single member LLC and you decide to invest as a passive, let's say in one of your deals, just the paperwork alone is not worth it, to be honest with you. So I would rather just put it in my name.
Okay.
And now if you and somebody else, and let's say that 4 people, get together so that they can put the minimum. Let's say you have a 100,000 minimum on your deal, and each person has 25,000, and 4 of them get together. Then they can go ahead and invest in an LLC, but that's going to be a partnership that's investing in your deal. That way they could raise the minimum for your whatever that is. So then I would probably suggest doing it. As an S corp or a C corp, I would not suggest investing in with that, only for active real estate stuff that you're doing.
Okay. So what about if investor from out of state, let's say they are from California, investing in Texas, where do they, is it advisable to do with LLC, and is there a place that they need to create that LLC either in Texas or California?
Well, I know for a fact the California Franchise Tax Board is you're at a disadvantage because you have an $800 minimum tax per year for each entity that you create. So I would most likely if you're from California, I would probably just invest with the personal name if that's the case. So.
Okay. And what about other states in general? Is there any states which is different from?
Yeah, I would probably say with once again, look at your state. Illinois, I know is like $160 a year, simply because I just know because I have some entities that I deal with there. Okay. The California Franchise Tax Board I know is much more difficult to deal with than the IRS. So.
Okay. But let's say even though they have a LLC, are they able to claim like whatever? Let's say they go for an education program.
Right.
In Texas, are they able to claim under
this is a misnomer. Education programs are not tax deductible. So that's one thing that everybody should know. Because some people invest, like 20,000, 30,000, like on Robert Kiyosaki or whatever. And then they think they can go ahead and write that off as a startup expense or something like that. If you read publication 550, you can't deduct that whatsoever. Now, if it's a membership in a real estate group, there could be an argument with it. We're still testing the waters on that one. Where you basically put that fee, that 20,000, let's say that you bought into the real estate, either the guru but basically it's members, so basically in order to be able to invest in that deal, you have to be a member of that group. So that creates the membership fee. So that could be either put in as an unreimbursed partner expense, which could be basically deducted later on. If you're investing in a single family home, maybe we could add it to the basis of the property that got purchased. But once again, you can't really do much with it until the property is actually sold. So you can't take advantage of you can't write it off and take it off of your income for the year. So I hope that makes it clear for everybody.
So what about if a passive investor is traveling to Texas or
right? So once again, he can put that's an unreimbursed partner expense. what we do is that we add it on to his K1, so that, let's say that he drove to the property, then all the mileage, say he drove 100 miles to go to the property to see it. So that 54.5 cents per mile, that's 54.50. That 54.50, we can put it as an unreimbursed partner expense. If he stayed at a hotel overnight because he wanted to take a look, go over the meetings that you guys had together, and any kind of food that he had, you could also, 50% of it could be deducted. However, any kind of entertainment is no longer deductible. So those can be done, but once again, they're part of the unreimbursed partner expense, and if there's losses at the beginning, they just get carried over because it goes, because you're a passive investor, it just gets carried on to the following year.
Okay, got it.
Okay.
So you don't get the benefit immediately, but when the property is sold, is that right?
Well, either sold or when the property starts producing income. So
okay, got it.
Well, let's say that this year you had 20,000 in losses from the property, and then on your personal K1, 1,000 of it came on your personal K1, and then you had about 400 that you spent at a hotel, or even your airline ticket, whatever it is that you did. That basically gets added on. So suddenly you have 1,400 in passive losses that are going through. The 1,000 that's on K1, and then the 400 that's like on your personal side, on the outside basis. So then that gets carried over to the following year. And then let's say that the following year you had a $1,000 profit that came through to your K1, then that 1,400, gets applied towards it. So you will only have about 400 that will carry over to the year after that. And then if the property gets sold and you made a $20,000 profit, let's say on year 3, then 19,600, I guess, will be your capital gains. So.
Okay.
All right.
Okay, thanks.
Okay. And then the self-directed IRA, Marie's going to talk about it at the end, and this is for investment purposes only. So I invest with my own IRA as well. So. You're going to need a team of professionals, especially if you're doing a lot of your own work. You're going out buying houses, you're going out purchasing things. You're going to need an accountant. You're going to need an attorney if you're going to draft your your LLCs and your S corps and all that kind of documents. Your real estate agent and broker, who's going to be helping you purchasing the properties or looking for the deals, or if you are using a real estate agent, you're going to need contractors. And it's always good to have a good contractor because I would say actually all contractors have been known to fuddle. I haven't had a great experience with all of them, and I've had some great contractors, but even they tend to lie a little bit. So, but you still need to find a good one. So, who can help you with the construction or whatever it is that you're doing with the property. Inspectors, home, people that come in to inspect the properties, appraisers, architects, a good title company, a mortgage lender and broker, a hard money lender if you are going to be fixing and flipping a property right away. Good record keeping. Stay organized. Keep all your receipts and invoices. Have a system. A credit card receipt is not a receipt. Always keep the detail on that receipt. So we need one that has the detail as well. So if you went out to dinner with your, with somebody that you're going to be investing with, and you bought the dinner, then you got to have a detail of that dinner. You can't just put the the $100, let's say, that you spent on that dinner just by the credit card receipt. You need the actual what was purchased on it, and then with a little. And I usually put a note on top of it saying had dinner with Marie, about this and this, and then that way we know what it is.
And Nick,
yes.
Oh, Nick, I'm just going to interject real quick too. A lot of misconception is that people think that, well, I use my debit card and it's on my bank statement, and that's good enough. And the IRS doesn't consider that support for your deduction. So you actually do have to have a receipt. So the line item on your bank statement, if audited, would not hold water.
Yes, correct.
So all that becomes critical when there's an audit, right? Otherwise,
Right, this is in case of an audit, right?
Okay, yeah, because I do the credit card statement thing, so now I need to fix myself, I guess.
Missed transactions equals missed deduction. So if we didn't take if we didn't take it on your tax return this year, we either have to go back and amend it, or you just missed it. That's basically it. It also saves you a lot of money in a potential audit. So, because if you need the proof as much as possible. So I have this little thing called Tiny Scanner, and I just scan every receipt and immediately send it to my email for whatever business it is, and then I always have it. There's also, like, if you want to pay for it, there's things like Receipt Bank and stuff like that. But also, if you use it like QuickBooks Online or Xero or anything like that, they also have their own, where you can take a picture of your receipt and send it in right away as well. So there should be no reason why you're missing on the receipt. You just have to do it right away. I have a couple of restaurant clients, and they tend to be very lackadaisical about it. And they've gotten a lot better now, because, they're in a rush. They go buy, let's say, the food product for their restaurant. They just get in their car and go. And I told them, you know what, just take 3 seconds, take a deep breath, take a picture of the items that you just bought, the invoices, send it immediately to that email, and you're fine. Because once again, just because it's on the statement does not mean that you can take the deduction. So unless there's an invoice behind it. And know your cash balances, perform your bank reconciliations. I would do it at least on a monthly basis. If there's very few transactions, at least quarterly, balance sheet, you need it for business returns and for your loans as well. If you're, as a single, if you have a single member, if you're a single member or LLC, or just a sole proprietor that owns the properties, you don't really need a balance sheet for that. But if you are getting a loan, the bank is going to need to see a balance sheet of some sort. You have accounting software options. We've got QuickBooks Online, Xero. If you're going to do an S Corp or a C Corp, make sure you have a payroll company as well, like Gusto or Square Payroll or ADP or Paychecks. There's a whole bunch of them now, and they're very competitive. I use Gusto and Square Payroll quite a bit, so it's pretty good. And I'm also, if you're going to be doing, if you have property management stuff, you got to use a good property management software like AppFolio, Buildium, or Resman. I think if you have a property manager that's doing all the property management for you, make sure that they give you good reports as well. So,
Nick, I'm just going to go through real quick a couple questions that popped up on the chat box on that. A lot of people were asking about how long do they need to keep their records?
Yeah, I would probably keep the records for at least 3 years. I tend to keep them for about 4 years myself, just to be on the safe side.
Isn't there some kind of guideline of 7 years or something, if I'm not mistaken?
Well, 7 years is if they go back. 6 years is if they go back. If there's fraud involved, they'll go back up to 6 years. So,
Okay.
and that's it. If the IRS considers it fraud, if you're like underreporting 25% of your income, and they'll go back 6 years. But 3 years is the main thing. They go back 3 years. I would say the majority of the time they go back 3 years, especially to find errors and things like that. So, because the majority is going to be an error that we need to fix
the other thing was, people are asking, yes, scanned copies are as good as the regular copy. So yes, actually they're preferred because the ink now on receipts fades away very quickly.
Right. Oh yes. Yeah, that's a good point. So business tax deductions, there's normal and ordinary. Good records are critical. Maximize tax deductions. Tracking your mileage. So if you use your car 100% for something, that's an audit flag. Now, if you bought a truck, and you use that truck for your restaurant business, and, you can't really park it on a street or anything like that, then you can probably do a 100% use. However, if you're using your personal vehicle to go and purchase things for your business, like office supplies or, I don't know, wood from Home Depot or whatever it is, all that mileage, or even to go visit the property, to visit tenants or anything like that, that make sure you are tracking your mileage. Use an app like Track My Drive, MileIQ, MileBug. I use my LIQ. I love it. I pay the $60 a year, and because I also categorize which business I'm billing for it, so I'm able to bill each business for it, and it's perfect, you know. So
yeah, I use my IQ too. I think yearly you get some kind of coupon like $20 off kind of thing, so you get like
oh,
40 or $50.
yeah. I wish I had known for that $20. I should have looked for it. So,
But it's really good. It's awesome.
and then there's also things like capital expenses versus repairs. So generally, if it's more than $2,500, it must be capitalized. So if you're fixing like an entire roof on your building and it's $30,000, you can't expense it. You have to capitalize it. And if it's a residential building, it's over a 27.5-year life. If it's a commercial building, then it's over 39 years. Rehab projects are all capitalized simply because they're not in use. There's no income coming in at that time. So you need to capitalize all those costs. Repair costs are your routine maintenance. So let's say that you have, now if it costs you, let's say, $2,000 to fix part of the roof, you can definitely expense that because it's less than $2,500. If you're purchasing an appliance and it's less than $2,500, you can definitely expense it now, under repair, because you're basically replacing the other appliance that was in there. What else? What other could be like a repair cost? If an HVAC cost as well, let's say that somebody comes in to fix your HVAC and it costs $3,000, it could be a repair cost if it didn't add value to your HVAC system. However, if it did add value to your HVAC system, in other words, it increased the life of it, then most likely you would have to capitalize it. Like even lawns, things like that. So yeah, those are all ongoing business expenses, that you have to do. Closing costs. Closing costs are mostly capitalized, and they are usually amortized over the life of the loan. So if you borrowed, $1 million and they charged you $20,000 in loan costs, that $20,000, and it's a 10-year loan, then that $20,000 gets amortized, $2,000 per year over the life of the loan. So that's the only way you can expense it. Types of taxes. There's a whole bunch of types of taxes. So we got property tax. That's the number one tax that everybody has to pay as an owner of a property of some sort, whether it's your personal residence or an investment property, or even as a partnership with other people that you're buying a property with. That property, if it's the property tax always has to get paid. So no matter what. Income tax, federal and state. So if it applies to you, and if you live in California, you have like very high, it's a high tax state, like Illinois as well as a high tax state. You have to file your income tax return every year. Make sure that it's, on the personal side, it's April 15th. On the S Corp and partnership side, it's by March 15th. Self-employment tax. If you have Schedule C or guaranteed payments, we're going to talk about guaranteed payments when we go over the K-1s. All those payments that you get is, like me being an accountant, if I didn't have a partnership with somebody, then those would go on my Schedule C. And all those fees, I would have to like deduct any kind of expense against it. That way I could pay the most minimum tax possible. Because the self-employment tax is at 15.3%. You have to pay 7.65, which is the employee side, but since you're an employee of your business as well, so to speak, you're paying the 7.65%. As an employer as well. And so the government wants their 15.3% no matter what. Excise taxes, we got, state and corporate, sales and use taxes. These are just, anything that you purchase, some goods. If you buy some goods in one state and you sell it in another state, you might need to pay the sales tax, the difference between the two states as well, which is like the use tax as well. So you got to be careful with all these taxes, especially when you're buying, especially if you're buying for an active business, Forms to file and retain, 1099 and W-9s. So make sure if any contractor that comes in, make sure you get a W-9 form from them. That way if they're an S Corp or a C Corp, or if they're a disregarded entity, or if they're a partnership. So anything that's a partnership or a disregarded entity which is an LLC, or if I use my own social security number as a contractor, I have to 1099 that person, especially if I have $600 or more in income that I paid them out in income for the year. W-2, W-4s, I-9s, those are all for any employees that you hire. But if you have an S corp, you have to make yourself an employee of that business and give yourself a salary as well. And then there's also payroll taxes. So there's a difference between owners and employees. The employees pay their own 7.65%. We pay the 7.65% additional for them. And obviously for us, we would have to pay the full 15.3%. State unemployment tax, and then the federal unemployment tax, SUDA and FUTA. So each state has their own unemployment. So just make sure you follow their laws and make sure you're registered and pay their quarterly fees and quarterly taxes that are owed on each employee. I would highly suggest outsourcing the payroll. Gusto and Square Payroll are my two favorites. They're also the cheapest out of everyone.
So Nick, the question I have on that slide, which is similar to one of the questions in the chat box, is let's say a passive investor investing in a state that doesn't have a state income,
yes,
like Texas and Florida, do they still pay a state income tax?
They're probably going to have to be, if there's a profit, they would have to pay the state income tax in their own state.
Even though they're from other states and investing in
but if there's positive, because they live in that state, you see. So
even though the profit is made in Texas or Florida?
Right, yeah, they would still have to pay. I mean, most likely they will have to pay taxes on that income as well. So,
okay.
Yeah, because, because it's a positive, they live in that state. So because they live in that state, they need to pay the tax on it. So my properties are all in Michigan. And so I pay my Michigan tax, but there's no tax in Texas. So there's no, so I don't have that. I still have to pay the Michigan tax because of the income that's sourced in Michigan. However, all the other income that I make, I don't have to pay it because I live in Texas. It's my state, it's my tax home. So there's like different things, that you have to consider.
Okay, if you stay in Michigan, then you have to pay even though you're investing in Texas.
Right. So if I lived in Michigan and let's say my employer's in Texas, I would still have to pay taxes in Michigan. And so no matter what, the state income tax for everything.
And I would just say that, state taxes vary from state to state. And so you really, if somebody has a particular question about a specific state, we can address that. They can call us, we can address it.
Right. Okay. Because I have to look it up as well. Yeah, each state is different as well. Yeah. So. All right.
Okay. Yeah, we'll answer the questions on the chat box later on, but keep on putting in all the questions there.
Sounds good. Okay, gain and loss on sale. So how is a gain and loss calculated? So you bought a property for like $1 million and you sold it for $2 million. So the sales price would be $2 million minus the selling expenses. Let's say that you had, $50,000 in closing costs. So that's a $1,950,000 minus the cost basis of $1 million. You have a $950,000 gain there, right? Minus the depreciation that you took over the year. So let's say that you had an additional $200,000 in depreciation. Now you're at 1.15 million as the gain. So that's how much you would have to pay. If that makes any sense, what I just said. So
if you have taken a lot of depreciation, then your gain becomes bigger, I guess, right?
A lot bigger, yeah. And then the depreciation gets taxed at ordinary rates up to 25%, and then versus the rest, versus
So what's the best strategy? Do we take, I know we talk about, I'm sure you're going to talk about later on about getting I would
probably, there's a thing called bonus depreciation. Now, if you take a lot of bonus depreciation up front, it's great because, you have to carry it over, year after year. However, when the time comes to sell the property, all that gets recaptured. So you're going to have to pay the tax on it at that point. So sometimes I would suggest you're better off, just taking a straight line depreciation, let's say, versus taking the bonus depreciation. You know, and there's elections that you can do on the tax return for that. So capital gains are taxed at 15% or 20%, depending on your income. I believe over 440, I think, it goes to 20%. Ordinary income goes up to 35%. That's the maximum tax rate. It starts at 12 all the way up to 35. Your recaptured depreciation at 25%. Then you got advantages of real estate. The advantage of real estate investing is you got the long-term capital gain treatment. So, you know, 15%, which is pretty good. You know, for most of us, it's 15%, which I think is really good, especially in this tax environment. So, so I think, I mean, I even suggested not doing a 1031 exchange because it's at 15% to a lot of the clients that I have. Unless you have like at least 60,000 or so in profit, you know, I would probably not suggest doing a 1031 exchange. You're better off paying the tax versus the fees that the exchange intermediaries will charge you. So
you're saying that if it's less than 60,000, it doesn't make sense because the fees are, you know, just
because you got 6,000, probably, you know, 6,000 in fees that the exchange intermediaries are charging you. Then you know, it gets held for a certain period of time, and then, you know, and then you got to comply. You got the 45 to 180. You know, you got 45 days to identify the property and 180 days to buy it, something like that. I forgot exactly what it is. So
much pressure, right? So
right. So there's a lot. Like I said, yeah. So you're probably better off just paying the tax, you know, instead of all the fees, you know.
Okay.
So that's just my suggestion.
Yeah. So that's the secret, guys. I mean, everybody claims that 1031, there's no tax, in all case, but in general, I think what Nick is saying is there is some guideline where it makes sense to do 1031 just because the fees and, you know, all that, you know, eats up into your value, and you have additional limitations. So if your savings are more than 60,000, it's better to do 1031, but if it's less, you know, what he's saying is it's not.
Right.
And Nick, the question I have on the depreciation again. So let's say someone is buying a property to flip it in 1 year. Let's say you buy a big apartment complex and you want to sell it in 1 year.
Right.
So that doesn't make sense to do a bonus depreciation, right? Because in 1 year you're gonna recapture it back.
Right. Yeah. You have to sell it within a year and a day. So if you sell it less than a year, the whole property then is actually ordinary income at that point. So
yeah, no, I understand that. I'm just trying to find short-term versus long-term. So let's say another person who want to hold that property for more than 10 years or 10 years, right? So at that time, hopefully, you know, the property equity has built up as big enough. So when you pay depreciation recapture, you may not feel the pinch, right? So,
well, over 10 years, you'll have a lot more depreciation during that period, you know, versus 2 years, you know. So, you know, you still have to recapture the depreciation. So
correct, but hopefully the property prices have gone up. You have built up so much equity, so even though you pay off that depreciation, you don't feel the pinch versus 1 or 2 years. Versus 1 or 2 years, because you haven't even eat up the equity yet, and nowadays you have interest only loans, right? Which means you're not paying down your mortgage, so your mortgage basically didn't come down. But so it's not all the time we want to take depreciation, you know, in any real estate, right? So you have to see what's the strategy.
Now, I know that, you know, a lot of real estate, you know, a lot of people do a cost segregation now when they buy a property. So I follow the depreciation schedule on the cost segregation versus, I know that I could take the full bonus depreciation on it, you know, there's like not an issue. However, it creates such a huge loss at the beginning that it doesn't make sense to have that huge depreciation carried forward, especially when I know that when I ask the investors, you know, they say most of them want to sell it within 3 to 5 years. So when they want to sell it within 3 to 5 years, I just say, well, why don't we just do the straight line depreciation like it suggests in the cost segregation study itself? That way you just take a certain amount each year, and then it's not as bad when we sell it. So
okay. So what you're saying is, if it's a short term, less than 5 years, it's better to take a linear depreciation.
Right. And if you have it over a longer period of time, then go ahead. You know, if you know you're going to be out of it, and because now, you know, I think the Fannie Mae loans are 12 years now. So
10 to 12
some people are probably going to carry it over till the 12-year period. So if that's the case, if you're going to hold on to the property for at least 12 years, then go ahead and take the bonus depreciation at the beginning, you know, because by that within 12 years, you will probably have accumulated all of that.
Okay.
Anyway.
Okay. That's a really good information, because whatever I'm hearing is like, take as much depreciation day one, and everybody is jumping up and down, but
Right.
you
Yeah.
need to make sense out of it, right? When you want to sell.
Right. Exactly. Right. So when you want to sell it. So,
But you are capturing at 25%, which is lower amount. That's a benefit, right?
Right. So here's some passive loss rules. Here's the general rule. Passive losses can be taken to the extent of passive income. So let's say that you have passive losses in this property this year, of $10,000. You can't take that loss because it's passive if you have nothing else, if you have no passive income going against it. So let's say the following year it carries over, however, to the following year. So let's say that you had passive income of $2,000 the following year. Then you can take 2,000 of that 10,000 goes towards it. So you pay $0 on that 2,000. You don't pay tax on that $2,000 in passive income that you receive because the passive loss carried over. So and a special rule, 25,000 loss from rental real estate in which you actually actively participate. So this 25,000 is for incomes that are up to 100,000. It starts getting phased out between $100,000 and $150,000, and anything over 150, you can't take that $25,000 loss whatsoever. So, suspended losses. This is sufficient passive income or gains to offset. And also, when you sell the property, that's good because when you sell the property, those losses go towards it, so you pay a lot less capital gains. And here is a K1, a little,
Hey, Nick, one more question on the previous slides. So the 25,000 is if you are not a real estate professional, right?
If you are not a real estate professional and you are actively managing the property. So let's say I bought a house that I rent out that I rent out. I go there, I go clean it, I go take care of it. I actively participated. I go find the tenants, I do all of that work. Then I'm actively participating in that property. So let's say that I make 100,000 in income, then I can take up to 25,000 in losses that's coming in from that.
Okay.
Okay. Now, if I'm not actively participating in it, I have a property manager taking care of everything, that I can't take any of those losses. That's a passive loss because I don't have any passive income going against it. So now, if you're a real estate professional, it's really unlimited at that point. But we'll talk about that a little later. So the real estate professional thing. So
okay.
Now if I make 125,000, I'm just going to go to the halfway point. I can take 50% of that, between 100 and 150, right? So the halfway point is 125. I can take 12,500 in losses at that point. Does that make sense? And then the rest of it carries over, because it phases out between 100 and 150, and it's proportional.
Okay.
All right. All right, and here's the K1 that everybody receives. You have you all invested in a property. Here's the K1 that everybody gets. So, we have the profit. We have all the people's information, the company information, all of that. And I just made it an individual one, so that's a limited member. Let's say that he invested in the property, and there was, so let's go to item K, partner share of liabilities at year end. I think everything else is pretty self-explanatory. Non-recourse is the loan.
Hey, Nick, can you use your mouse to point where you're looking at?
Oh, I'm sorry. Can we see that here?
Yeah, okay, good.
Did everybody see that? Okay, all right, so right here. On item K, so 1,000. That non-recourse loan, this is a loan that there's no recourse. It's basically the building is guaranteeing it, and it doesn't apply to any of the other members. There's also qualified non-recourse financing. So basically the KPs are in charge of this kind of loan. So they are the ones that are guaranteeing it, so to speak. And then recourse is any amount that basically everybody is responsible for. So usually it's like the accounts payable, things like that, that's mostly recourse. Anyway, whoops, page up. Let's go to item L, Partners Capital Account Analysis, Beginning Capital Account. Since you just invested in the building in 2017, this is in this example, there was no beginning balance. So in 2018, you would have a 40, because the ending capital account is 40,000. That would be your beginning balance in 2018. So the beginning so you have capital contributed during the year, 50,000, and then the current year increase or decrease minus 6,000, and then withdrawals and distributions 4,000, which brings us to the 40,000 at the end. So if we go into the K1 here on the right side now, the right column, we got net real estate income of $6,332, right? And then we have a net short-term capital gain of 20. So let's say that, you know, we sold like an appliance at a small capital gain, you know, that we bought and sold something, and you made $20. That was your portion that came in. That gets added into your capital as well. And then net long-term capital gain. So let's say that we did a partial disposition on a, you know, on a building of some sort, and you know, we got rid of, you know, the roof, and then we replaced it. But however, there was like a small gain in there. We can take that portion and put the 312 on it. So and that comes out to $6,332. And then we got, I forgot about the $2 interest income. There's always that $2. It should have been $59.98. Sorry, right there. So on the increase, on the decrease, I guess. So, okay, let's go to number 1, ordinary business income. So this is, let's say that you have a fix and flip business and you have a partnership with somebody. That's where that income would go. So any kind of profit that came in would be in, or a loss would go in number 1. That gets taxed at ordinary rates, and then it goes to your personal return at an ordinary, you know, and it passes through on a Schedule C mainly. Number 2, the net rental real estate income or loss. That's the $6,332 that I put there as an example. Most people during the first 2-3 years are going to have losses on here. So I would say don't worry about it. The majority of it is probably depreciation. You're also going to have a lot more expenses at the beginning because you're rehabbing the property. Since we have $2,500, it applies per item, so we can definitely expense a lot more items at the beginning. So you'd rather expense an item versus depreciating an item because you don't want to recapture it. Number 3, other net rental income or loss. This is mainly, you know, probably from like another entity that's flowing through in there, or, you know, I hardly ever see that one. Actually, I've never seen it filled in. So guaranteed payments. So a guaranteed payment is something that you receive, which is number 4. It's something that you receive from the partnership, no matter what is going on in the partnership. The partnership could be losing money, but the partnership is still paying you, you know, $5,000 a quarter or whatever it is. That is a guaranteed payment, and that goes directly on your Schedule C on your personal return. The interest income is, you know, the bank accounts that the partnership has is earning some interest. That whatever portion of that income from your percentage that goes through, it goes through to your personal as well. Ordinary dividends, if the partnership is investing in stocks and bonds and all of that, they're going to invest in, or equity, you know, like mutual funds or anything like that. Any dividends that are coming in also will get transferred into the, or even if it's a C Corp, if the partnership is investing in a C Corp and they receive a dividend from the C Corp, you know, that's another, that would be here. That's where it would be. Royalties, you know, they could be anything from oil. Most of the time in Texas, it's oil royalties. You know, people have the property, you know, the apartment building, and it's on some oil that's being contracted to Shell, and Shell pays you a certain amount each, I don't know, month or whatever it is. That amount will go in there, and then that gets reported once again on your personal return. The net short-term capital gain and short and long-term capital gain or loss, 8 and 9. Most of the time, these are going to be filled in when we have the property sold. So because anything that was done that was less than 1 year, so let's say that you made an improvement for $100,000 to the property, but you sold it in less than a year, then the net short-term capital gain will go under number 8. And then the rest of it, let's say $1 million in capital gain, the long-term one will go into 9. Then we got collectibles, unrecaptured. Unrecaptured Section 1250 gain. This is where the depreciation comes in as well. So So if you have a depreciated item, that's where that amount is going to come in. The 1231 gain, that's real estate related as well. That's going to go in there. Other income or loss. This is any other income that's coming in through the partnership. I've never seen it filled in for a real estate investment. So,
Hey, Nick, so I think we are going to be running out of time soon. We're already like 8:54. So
okay.
maybe you should just cover the multifamily,
All right.
investor portion. I mean,
go
just
back.
to summarize for the multifamily passive investor. So
Right.
based on your percentage ownership on the investment, let's say you own 5%,
Yes.
the depreciation of that property is divided. You get 5% of that depreciation.
Exactly. Right. That's how it is. So.
And if I'm correct me if I'm wrong, Nick. So if you invest with an IRA, you don't get that benefit, right?
No, because it goes to your IRA. So.
Okay, so it's the wasted portion of the
No,
depreciation.
but the IRA will have to file what's called a 990T. So.
Oh, really? Okay.
Yeah.
Okay. Somebody told me it's a wasted depreciation.
No. Always carry everything over. So.
But does the investor get any benefit?
Are straight depreciation no matter what. So it's bonus depreciation. Yeah.
Does the investor get any benefit at all?
Well, he will when he takes his money out later on in the future. So.
Oh, got it. So that is definitely benefit, I guess. Okay.
Right. Mm-hmm. Real estate professionals. I mean, I would probably just read the slide. Just go, you have to have a minimum of 750 hours and more than half of your hours must be in real estate related activities. You can group everything together if you so choose to. Otherwise, you can't take the deduction, basically, because it's physically impossible. If you have 5 properties, it's physically impossible to have 750 hours in each property. So most of you will probably group it together. Tax saving strategies. We already discussed that a little bit. The cost segregation and all of that. And here are the Tax and Jobs Act right now. There's 7 tax brackets.
Yeah, we can go this on detail because this is completely new, right? This is
completely new. So this is basically it. So if you're married filing jointly, up to 77,000, 12%, up to 77 to 165, 22%, 165 to 315, 24%, and then 32% up to 400, and then 37% is the max. Actually, I thought it was 35, but 37. It is 37. That's right. So that would be the maximum tax rate that you would have to pay, down from 39.6. The corporate tax rate is 21%. So it's so a lot of people are starting to convert a lot of their property management and all of that into C corps, so that they could just take advantage of this rate. The only thing is that you can't let the money accumulate in your C corp because eventually the IRS will want you to take money out, so in the form of a dividend. So then you got the qualified business income deduction, 20% for the pass-through entities. There's no personal exemptions. There's an increase in the child tax credit, and then the estate tax phase out by 2025. So by 2025, that's going to be gone as well. And then we got fewer itemized deductions, and they double the standard deduction. So whereas before, you could take the SALT, sales and local tax, all of that. You no longer, the state and local tax, you no longer do that anymore. It's only up to 10,000. So the majority of the people, I think most people now will be at the standard deduction rate anyway. So, and then we can discuss tax plans and things like that we could talk about. The medical expense is now greater than 7.5% from 10% that it was in the past. The student loan interest, you could still deduct it. The individual mandate will be over by 2019. And then you also get an elderly care tax credit for $500 for non-child dependent. There's this thing called the qualified business income. So 20% of the qualified business income, there's an income threshold phase out. Your taxable income has to be either up to 157,500 if you're a single filer, or 315 if you're married filing jointly. However, if somebody's earning W-2 wages, it can only go up to 50% of those W-2 wages, because that's where it's at. tax rates for the corporations. So once again, for the C Corp, I would probably do property and asset management, fix and flip, real estate professionals, brokers, dealers. And then rental income may be subject to self-employment taxes if you're a real estate professional, you materially participate in your rental activities, and you have short-term rentals like Airbnb, VRBO. So I put all my rental income from Airbnb and VR. Well, actually, I just do Airbnb strictly, and all of it goes through to my S Corp because I want to be able, and I take a salary, and then the rest of it comes in as dividend income. Passive rentals will not subject your rental income to self-employment tax. So no matter what, passive rentals, it's whether you're a real estate professional or not, if it's a passive, it's a passive.
So passive investors can never be a real estate professional if they just do passive investment?
Right. Well, a passive investment is a passive investment. They could be a real estate professional for other stuff that they do. You just have to group it under that.
Okay, so if they do flipping, let's say they do 1 or 2 flipping per year.
Right. I mean, the majority of the people are going to be passive in your deal, right? So they can't take advantage of it. They're not active in it, right? Okay. However, if they have a fix and flip business that they also do, or they're a real estate broker that, buys and sells houses, or a dealer, or a dealer that just buys a whole bunch of houses and, wholesales them and whatever they do, then that's a real estate professional, but you got to group everything under one item. So
okay,
you got to group it together. And then once you group it, you can't ungroup it, number 2. And then you can't decide the following year either, oh, I'm not going to be a real estate professional this year because I don't have the hours, because then they get all locked up and you can't do anything until the property gets sold. And then not only one property, you got to sell all of them. So it's really, really difficult. I tell most people not to choose real estate professional. So that's just my thing. But
okay, so it comes with the property that you tagged it with, I guess.
Yeah. So if you have 5 properties grouped under that, right, and then the following year you decide not to be a real estate professional because you didn't have your 750 hours, all those losses get locked up. Everything gets locked up. You can't do anything at that point until all 5 of those properties are sold. Not just one, all of them. So be really careful with a real estate professional. All right. And then bonus depreciation. I think we discussed it a little bit. Non-residential property, is if it's less than 20 years, those are your commercial buildings. It doesn't apply to multifamily because those are all residential. On the residential side, you got the personal property that's used in the rental unit, all the furniture, the appliances, and everything. You can get a Section 179 deduction, which is kind of like a bonus depreciation for the full amount. So it went from $520,000 to $1 million. The bonus depreciation is 100% qualified property. If it's less than 15 years of straight line property, so in other words, like your land improvements, your fences, your signs that are attached to it, your playgrounds. What is it? Those are all 15-year items. Anything that's like 7 years is probably like the office furniture in your apartment buildings or the computer equipment, all of that. That's like 5 to 7 years. Those all also get to be 100% depreciated right away as bonus in the first year that they're placed in service. So once again, the passive activity rules always apply, the losses, and also the new business loss deduction rules also apply with this. So, and the new thing here is we got the business loss deduction rules. So beginning this year all the way up to 2025, you can't deduct an excess business loss in the current year if it exceeds $250,000 for single filers and then $500,000 for married filing jointly. Now, if it's less than that, you can. So that you can still carry that over. However, what happens is that loss basically gets carried over to the following year. You just can't take it this year. That's one of the new things that they created. However, if you have passive activity losses at the beginning that you can't take, those will go first, which means that you can't take the business loss deduction if you have passive activity losses as well. So, but they will carry over. So don't worry about that. You'll just have to take it in another year. And now I'm gonna pass the baton to Marie to talk about IRAs.
Yep, there we go. Okay, my name is Marie Dansu. I'm a CPA. I am licensed both in Illinois and Texas. I've been a CPA for over 25 years. That kind of dates me. But I've been involved in real estate. I've been involved in kind of being a CFO of different companies. So I have a very broad range of experience that I bring to the table. I myself use my self-directed IRA to invest in real estate. I use it to invest in notes. So I particularly like to lend money in my IRA, and that's what I use it for. And I'm a huge fan of this type of investment. It really has a lot of advantages. So what is a self-directed IRA? So just to give you the basics, it's an IRA where you, the owner, actually direct and manage the investment in that IRA. You use a custodian, and you can choose the type of investment you want. Charles Schwab is or Scott Trade, something like that, is a self-directed IRA type program. Only that custodian only lets you invest in what is called a typical asset, which is your stocks and bonds, your mutual funds, everything that you can really do on a stock exchange. You have to move to a specialized custodian to do what is called alternative assets. And real estate falls under this alternative asset umbrella. So does gold and silver. So does investing in a private company using your IRA. And as of late, the biggest thing to do is use your IRA to invest in cryptocurrencies. So all that is possible. Just to give you a quick idea of how you do that, how do you actually establish a self-directed IRA? First of all, you need to work with professionals who specialize in this industry. You open up your self-directed IRA account. Like I mentioned, you have to have a special custodian. Two of the ones that I find very reputable. There's many of them out there, but the two that I use most often are Entrust and Pensco Trust. And there are a huge array of them, and they're all very good. You just need to choose wisely and look at the fees that they're going to be charging you. And each of these
charges the most fee, if you can quickly give us some guideline?
I'm sorry, I couldn't hear you, James.
I mean, there's like Quest IRA, and there's
yeah, there's like New Direction.
So I mean, who charges the most based on your knowledge? Because we don't have time to go and see each one of those, right?
Right. Entrust, I like Entrust because they do have very reasonable cost structure, and they run special deals for new customers. A lot. So Entrust is an affordable solution. The Pensco Trust is probably the most expensive. They are extremely reputable in the industry. And if you have a very complicated transaction, that's where I would go, because they ensure that you are doing this properly and that your IRA is in compliance with all of the IRS and Department of Labor laws. So.
Okay.
So, but they vary. So, do your homework. And that's just a quick overview. So once you open up your account, you need to fund it. And you have two general ways of funding that account. And one is through making a contribution to an IRA. And that is very limited because you're limited to your contribution rules. So whether it's a traditional or whether it's a Roth, you're limited to your annual contribution limit. So most people, when they invest in a real estate project, they're rolling some funds over from an existing IRA that they have, or they've just retired, or perhaps they got laid off from a position where their 401k, their employer's 401k now becomes available, and you can roll that, all the money you've accumulated in that 401k over into a self-directed IRA and use that to invest in real estate. So this is a much more common way of doing it, making a contribution. You can do that annually once you kind of get that bulk of funds into your IRA. Then you choose your investment and how you're going to invest in that. Your IRA, just like a person, your IRA can invest directly into your real estate project, or your IRA can open up an LLC and invest in that real estate investment. So either way. And I could do a whole webinar on using LLCs to invest, having your IRA be a member of that LLC. So things can get very complicated, and you can do a lot of different things with this type of investment vehicle. But just want you to know that that option is out there. What can my IRA invest in? Well, there are permitted investments, and then there are prohibited investments. Permitted investments, the only qualification is that that investment has to be for investment purposes only. So just as you're going to invest in Apple, you're doing it to make money and to accumulate funds in your IRA. Right? You're not going to be using it for your personal use. Prohibited transactions or prohibited investments are things that the IRS specifically say no to. And those include a list of investments. I'm going to get to those. And then what they consider prohibited transactions. And prohibited transactions fall into two categories. One is being, you cannot invest with a disqualified person, and you cannot self-deal. And in the next slide here, I'm going to explain those. So what are permitted investments? In real estate, there are a wide variety of things that you can invest in, and these are just, some of the ones that I could think of off the top of my head. But you really invest in what you know. If you do residential rental properties, you can invest in those. You can do multifamily apartment buildings, condominiums, raw land, office. You can do strip malls, farms, storage units, mobile home parks, golf courses. If that's your passion, you can invest in golf courses. If you want to do overseas, you can use your IRA for international property as well. So really, it's unlimited. The prohibited investments or prohibited transactions are things that the IRS specifically say no to. And the first thing is collectibles. The IRS considers artwork, antiques, stamps, and classic cars, wine collections, and really almost any other type of collectible that they would deem as being prohibited. So that nice wine collection that you have down in the basement, you can't use your IRA to continue to develop your wine cellar. The IRA is not going to take the IRS will not take kindly to that. So you cannot invest in insurance. So your IRA cannot purchase a life insurance policy on you or anybody else. And S corporations, your IRA is considered a trust, and most trusts are prohibited from being shareholders in an S corporation. So those are the three things that you specifically cannot invest in. And then you move to prohibited transactions. And the first type of prohibited transaction is one where your IRA invests with somebody the IRS says is a disqualified person. And you can see on the chart that a disqualified person is anyone who is in linear descent from you. So it's you as the IRA owner, your spouse, your children, your daughter and son-in-law, so your children's spouses, your grandchildren's spouses, your parents, and your grandparents. So it's anybody in direct lineal descent from you. And so what that means is that if you're going to buy a big rental house, let's say you're going to buy a 4-flat, and you want to do it with, I'm going to invest my IRA, and my children come to me and say, my adult children's come to me and say, I want to also invest in that. Well, I can't use my IRA to invest with my children in that piece of property. That would be considered a prohibited transaction. So who does that leave? Well, it leaves a lot of people open who your IRA can do business with. And in your immediate family, it would extend to brothers, sisters, aunts, uncles, cousins. Those are all people who are perfectly fine to invest using your IRA funds with. Your in-laws, your father and mother-in-law, your children's in-laws, step-parents, step-grandparents, step-siblings, and then there are others like friends, neighbors, business associates, and the stranger down the street if you want. So, so it does leave a lot of options open. Just a few other things that I'm just going to kind of touch on. Again, these subjects are, you could do a whole webinar just on some of these subjects, like leveraging your IRA. So non-recourse loan, you can use non-recourse loans with your IRA and invest in rental properties. Something like that is in the multifamily is when an investor is using their IRA to be part of that partnership, and you're financing that multifamily unit. You're actually getting a non-recourse loan using that IRA as part of it.
So are you saying that, let's say we take a recourse bank loan and buy a multifamily, people can invest with the IRA?
Yeah, so, well, in a multifamily situation, James, like as an investor in that, it gets into this idea of what is UDFI, unrelated debt financing income. So when your IRA invests in a property that has debt, has a mortgage on it, they're going to have to kind of pay taxes on that share that the percentage share of that debt financing. And I'll get to that when I explain what UDFI is. A real simple example would be that if I was going to buy a rental property with my IRA, I don't have any other partners. My IRA can actually go to a specialized bank. There's several out there that will do non-recourse loans just for your IRA. So
my question is whether recourse loan can be funded with IRA, like normal bank loan, and we go and buy multifamily, but it's recourse.
Who would, in a multifamily situation, right? Not if your IRA can't guarantee that loan.
Okay,
right.
I mean,
so if you're the lead
investor,
you have to guarantee that loan using your IRA funds. You wouldn't be able to do that, but you can take investors in.
Okay, so for passive investors, it doesn't matter. But I think if you're
if you're going to be the active investor,
okay.
Your IRA, because the reason is because you have to personally guarantee that recourse loan, and you can't personally guarantee a loan with an IRA because you would be entering into a prohibited transaction.
Okay.
You're self-dealing is what they call it. You're using your personal backing to make this investment, and they have to be completely separate. Your person has to be separate from your IRA investment.
Got it. So just for the attendees, we are running more than what we thought in terms of time. I'm really sorry about that. But if you guys want to listen more, we can go slowly or go faster. I mean,
James, I'm actually almost done. This
Oh,
is the
okay.
last slide.
Got it,
I'm
got
just
it.
going to touch on UBIT and unrelated debt financing, just so people are familiar with those terms. Again, we specialize in this area of investment and can delve deeper into that with anybody if they want to call or email us. So I'm just going to touch on it. Like I said, when a multifamily unit does have a mortgage to purchase that apartment complex, and you're using your IRA funds to be a passive investor, that you just have to know that you will have what's called unrelated debt financed income. And it's a tax that you're going to have to pay. There's a special calculation for it. It's based on how much, what the average acquisition indebtedness is over the average adjusted basis, which probably is very foreign to everybody who I just said that to. But just so you know, if you're using an accountant that is well versed in this, they know the calculation and will do it for you. But it's basically a percentage of your share of the income that's on that K1 is gonna get taxed. And your IRA does have to file a tax return. So you just need to be aware of that. Your IRA is a separate entity when you're investing in as a passive investor, and you will have to file a 990T.
Yeah. Let me make it into a slightly simpler terms for some of my passive investors who find it hard to understand the terms. So basically, whenever we take a loan to buy multifamily, I mean, this is all comes into the play when we buy a property with a loan, which almost everybody take a loan.
Everybody does it, yeah.
Yeah. So let's say you take a loan for 80% and 20% is what we are putting down. So let's say your profit, grew up, become 100% more in, 3 years down the road. You are going to be paying, or you're not going to be getting 100% of your gain as tax-free, right? You're only going to get 80% of that. Does that right? Sounds right, Mary?
It does. But as you're paying down the debt, if you're holding it on for a long period of time and you're actually paying down the debt, the mortgage on that property, the amount of tax that you're going to pay on that property keeps going down as that debt gets paid off.
Okay.
Right. And I have a couple of questions, sorry to interject. One of them was in a self-directed area where the IRA funds are combined with cash, can a disproportionate allocation be used to favor the cash side of the investment? So in other words, can it get a bigger percentage? I'm assuming that's what it said, for the cash portion. I think it's whatever the partnership decides, right? As they have in the operating agreement.
What is the question again?
I think do they want to invest personally with cash and then with their IRA?
I think, that could still be done, right? I mean,
it can still be done. You just need to be careful. There's certain rules. Again, you don't want to get that self-dealing prohibition. So there are specific things that you have to follow when you do that.
And then another question was, are life settlements prohibited? I think they are, but I don't know. But
what? I'm sorry, I couldn't hear you.
Are life settlements prohibited? Life
settlements.
I'm assuming an insurance settlement. I think any kind of insurance is really prohibited.
Oh, okay, yeah. If they're asking for insurance, your IRA cannot purchase insurance.
Right.
It doesn't really make sense in an estate planning way to have your IRA be a beneficiary of life insurance. It kind of negates the reason for having the life insurance. They're both.
And the last one is about the solo 401k. I don't think they need to do a tax return. Only the IRAs do.
Well, it depends on how much the solo 401k has under assets, because it's a 401k and it can be subject to the Form 550.
Oh, I see. Okay.
Yeah. Or 5,500, I'm sorry.
5,500, right. Yeah. Okay.
Yes, but the key here is that if you do use a solo 401k, it's not subject to the UDFI rules. That's kind of one exception to it.
So does that mean that we should move all our IRA to solo 401k?
Well,
business.
yeah, I mean, there are specific rules of opening up a solo 401k. So you do
Okay.
have to have an active business in order to have a solo 401k. It's
Okay.
just like a regular 401k if you work for an employer.
Okay.
You actually have to be employed by your own company to have that solo 401k. And you can be and it only works if you are the only employee. So if you have a whole bunch of employees working for you, it may not work.
Yep. I think one of the question I think was asked is in SDIRA where IRA funds are combined with cash. I think that's what Nick was reading. So from my understanding is in most of the passive investment, we don't allow, one person to have both IRA and cash in one entity. It should be separate entities. So it becomes like two-person. So
right, you can't, right, they can't be combined under one group.
Yeah.
If there is such a thing called simultaneous investing, it gets very, very complicated, and it's a strategy that you would use. It's a very advanced strategy to use. So.
Okay.
So here, this is the last slide. So your IRA, make sure you consult a tax accountant on your IRA investments, because it most likely has to file a 990T. They do get, the income does get subject to tax at trust tax rates, and those escalate very quickly. It's actually $12,500 profit, and you're taxed at a 37% tax rate at that point. So if you have income of that much going through your IRA, you're going to be taxed at the highest rate. And then you should file returns even if you incur losses. So if you incur a loss, you're not going to have UDFI tax because it's only on income and gains, right? So if in that first couple of years you are not, that property is incurring a loss every year, you're not going to have UDFI tax on that.
So when you say loss means, so minus depreciation, right? Because most of the time, multifamily investment is always negative. It's always a loss.
Exactly. Yes, right. So if and when it does start turning a profit, that is when you start paying the UDFI tax. But you still have to file the return. So you still have to consult your tax accountant to make sure that you don't have that 990T filing requirement. Because even if you do have losses, it's beneficial to file that return and have them carry over and be used at a later time at the sale of the property.
So let me clarify something. So in multifamily, I mean, I've never seen a K1 which is positive. It's always been negative because it's a depreciation, right? So, but when you sell is when you start to see the profit, I guess. That's when it matters, I guess, for the UDFI and UBIT, right? Otherwise, it doesn't matter. Is that right? Is that a right statement?
As long as there's a loss, then it doesn't matter.
Okay.
But again, you should still file that tax return because those losses will carry over just like they would carry over on your personal return.
Okay.
That's really all I have. Oh, I'm sorry. I shouldn't say that. I have one more. Is what happens if your IRA engages in a prohibited transaction, it gets audited, and the IRS revokes its status as an IRA. And what would happen is that your IRA loses its tax-exempt status. Everything in your IRA is deemed a distribution of your funds, and you have to pay tax on that. Oops, sorry. If you are under the age of 59 and a half, you're subject to the 10% early withdrawal fees. All of the distribution of income is taxed at whatever tax rate you're going to be at. And then there's an excise tax tacked on to all of that at 6%. And it is applied retroactively to the day of the transaction. So the day you bought that property, if it's 5 years later, all of that penalties and interest get tacked on to the original date of that transaction. So you definitely want to make sure that you're doing it correctly. You want to definitely make sure you're using reputable people who know how to deal with self-directed IRAs.
How do we know that we have lost it? Will we get a call? Will we get a letter? Or how have you ever encountered it?
I've had one person get a letter on it. It was fine. So that there was no issue with it. We just sent back a response. So no, I don't know anybody who's actually had it revoked, but it would be if perhaps your IRA got chosen for an audit, and that's the way they would find out whether you have invested with a prohibited person or have self-dealed. And those are the two main ways that you would lose your status.
Okay, thanks. Gonna go to the last slides, Mary.
So, and just to mention, if you're going to use your IRA to invest in the multifamily property, you shouldn't do it if you're going to be the lead person, the lead manager in that fund, because then you're self-dealing, because you're actively working that property.
Okay, yeah, that makes sense. Good.
Nick, do you have anything else to add?
No, I'm good. So
we can go to the questions which we did not answer. So you want to go to the contact information and then we can go to the questions?
Yeah, this is our contact information. We're down in Texas, in Irving, Texas. Here's our address. You can reach both Nick and I through info@wholetax.com. And we have a toll-free number, which is 855-348-5499. So please reach out to us. You can text us. You can send us an email with your questions. You can call. We'd be happy to help you out in any way we can.
So thanks, Mary and Nick. So let's go to the questions quickly on the chat box, whichever we didn't answer, I guess, right? So Nick and Mary, are you guys okay sharing the slides with the attendees?
Yes, go ahead and send them
out. Okay. So once we are done, we will send the recording and the slides out, because there were some of the questions. Will the presentation be available for downloading? The next question is membership fee also can be written off until property is sold? What if there is multiple properties? Remember, Nick, you're talking about membership fee is not
right. So if there were multiple properties, what we could do is if they were all bought in the same year, we could probably put a portion for each property that was bought. Now, if it was bought in a different year, obviously the other one won't get any of that, So, but until that previous property gets sold, because we added it to the other one from the previous year. So.
Okay. What about cost to attend a conference? Is that deductible?
You can expense those. That's fine. You can put those in the continuing education or something like that. It's just that those huge fees, the IRS is going to look at those. So, okay. if you spend like $1,000 to go to an event and things like that, those are easily explained. It's a conference. That was the attendance fee. It was networking. I was trying to get into other deals. Because there's a whole bunch of other things going on other than just education for that. So,
yep. The next question is, can you please explain what you mean by being capitalized as far as the repairs?
Well, capitalized. So if you're fixing your roof and it's under $2,500, so you're just patching it, you didn't add value to your roof. So then you don't need to capitalize. You can expense that. Now, if you had a hurricane or something that came in and ripped your roof off and you got a $40,000 job, and let's say that the insurance company only gave you $30,000, then that $10,000 difference, you have to capitalize that. There's just no other way to do that. So,
and capitalize means you have to recapture back, right? It's not like expense. Expense is gone day one.
Right. Yeah, and then also you sell out the other. You could do what is called so once again, if it's a small property, you will not do a partial disposition of assets. However, on a big property, it makes sense, because then you can write off that whole previous thing and then add the new item on. So add the new portion of the roof on. So
okay.
And I think capital is, for those who don't know, capitalization just means adding it to the cost of that piece of property.
Yes.
versus a repair, which is just taking that expense right away.
Okay. Someone asked whether if they keep hand notes of their vehicle mileage, is that okay? Or you need a digital
No,
tracker?
hand notes is fine as long as they have a log that they can prove to the IRS that they did it. So
Yep. Yeah, I used to do hand notes until I found MileIQ, and I only look at that once a year when I went doing my taxes.
right.
So easy. Next question, I read that you cannot offset W-2 income with depreciation for apartment investment. Is that true? No, that's not true, right? I mean, you
Well,
get
it depends. If you're an active participant, then obviously you can, up to 25,000. If you're not, then I mean, you have that thing that's called the net business loss now deduction as well. So first is going to be under the passive. If it's passive, only passive income can offset passive loss. So that will not change no matter what's going on. Now, if you're actively participating in it, the depreciation will go on to your tax return up to 25,000. So
okay. Can you clarify only passive income can be minus for passive?
So let's say you have a passive losses this year. You just invested in a property, in a multifamily deal, and then on number 2, it has that negative 6,000 in losses, right? That came through. So that 6,000 in losses that came through on your personal side, if you don't have any other passive income, interest income, whatever it is, passive income that's coming in, you cannot take that deduction on your taxes. It has to accumulate to the following year.
Oh, got it. So the property need to have an income, passive
Right.
income. Okay,
Right.
got it. So basically any multifamily which is giving you a passive income,
Mm-hmm.
you can definitely take a depreciation
Yes.
to offset that passive income. Okay,
Exactly.
got it. So,
Right.
so basically you can offset W-2 income with the depreciation from apartment investment.
You're an active investor, but not passive, right? So.
But for a passive income, as long as you have a passive income from that investment, you can offset that, right? I just want to make sure I'm clear about
Right,
that.
passive income, you can offset it then, right?
Okay,
Exactly.
got it.
Yeah.
Got it.
Up to the amount of the passive income.
Yep. So following that question is, even though one of the spouse is full-time real estate professional, so if a full-time real estate professional, then you're considered active, right?
No, then you're a real estate professional. That's like having a business. Then you have unlimited losses, actually, that can go through.
Okay. So the answer to this question is, since this person is an active, is a full-time real estate professional, it doesn't matter whether it's passive income or not. Across all income, you can offset.
Right, because he's an active real estate, he's a real estate professional. So
okay.
All income is going to be active. So.
Yep. And then he had one more question.
Unless he invests in a property, if he invests as a passive in a deal, though, that's passive. That has nothing to do with, it only is the properties that he's active in as a real estate professional.
Oh, got it.
I just want to make sure, yeah.
So if the person's wife is a real estate professional, they can offset unlimited income just for that property. If you're passive, then you can just do passive.
That's it. Passive income will only offset passive losses no matter what.
Okay, got it. And he said if he's living in California, invest in Florida, Texas, Georgia, and get a K-1, does he pay franchise tax in California?
I don't. He probably will have to, if there's positive cash income coming in and he lives in California, most likely he will have to pay something to the franchise tax board there.
Okay.
Yeah.
Even though it's out of state LLC.
Right.
Okay. So in a syndication, how are distribution tax? I think we covered this. Your distribution is distribution of depreciation is based on your equity in the deal.
Exactly.
Are they considered income or return or capital?
Well, depreciation is income, and it gets taxed at 25%.
Oh, okay. I think this person is asking about distributions of their passive income.
Distribution of passive income. Well, that goes against. So once again, any passive income that goes into the K-1, it increases the basis in your investment, right? Then anything that gets distributed from that will decrease that portion. Now, if you go below the capital basis, let's say that you put 50,000 in and you refi the property and then you give everybody 60,000 back. Then they go to a negative cash basis at that point. That negative 10,000 is taxed at a capital gain at that point. So
Okay. But is distribution considered income or return of capital?
the distribution is return of capital because the income is only going to be those items that are on the K1. So if it's ordinary income, he'll only pay the ordinary income tax, let's say in box 1. That's basically.
Okay.
But anything else that he gets over it, that's a distribution of capital. Because that portion increases your capital basis, right? The profit increases your basis. The losses decrease your basis.
Yep.
Then if you take a distribution on top of it, it decreases your basis even further.
Got it. So next question, do taxes work for fourplexes versus five plus units, 32, 65 units? It's the same.
Real estate is real estate. Residential real estate is residential.
Okay. Okay. I think we're almost done with the questions. If SDIRA, if I loan to a friend, what type of proof do I need to maintain?
Well, actually, you have to go through your custodian. So your custodian will tell you exactly what you need. You got to fill out their forms, and you have to, like, if you're lending money to a friend, obviously you're going to have a promissory note. So, and then whatever form that your custodian has, because they keep a copy of that in their files.
Okay.
And just make sure that you have somebody collecting the money. They usually want like a service agent of some sort to be collecting the interest on your behalf or whatever it is. So, or the payment on your behalf.
Okay, the next question, what about fees for real estate coach, consultant, advisor that helps with guidance on real estate? Is that tax deductible? Is there anything we can do there?
That's a gray area. I'll have to take a look at that. So,
okay.
Because I have to ask more questions really, like, and figure out how we can treat it. Because if he ever gets audited or she gets audited, then we got to come up with something that I can, like, argue to the IRS. Well, this is really not education. It's actually, they needed to participate. You know, they needed to be a member of this group in order to invest in this deal. So.
Okay. Can the driving log just be a distance, or does it have to be a starting and stopping point odometer readings?
Just a distance is fine.
Oh, just a distance?
Yeah, you know, you're supposed to have the starting and ending odometer readings.
Okay.
So here's what I say. Either get an oil change on January 1st of every year, and then you always have the odometer reading, or take a picture of your odometer on January 1st of every year. Happy New Year.
Exactly. Yeah.
When filing tax with dividends as a passive, what's the difference between filing as an LLC or an individual?
Well, the LLC, if there's a partnership, then it's a partnership return. If it's by yourself, if you're the single member, it's whenever you file your own personal taxes. So
if you're a single member, then it doesn't matter, I guess, right?
No. Well, it's kind of like being a Schedule C. It's like being a sole proprietor. The only good thing is that you have liability protection. So. Okay.
So just a liability protection rather than a tax advantage. All right. I think that's it. Thank you very much for everybody to attend this webinar. Thanks to Nick and Mary for presenting all this.
Thank you.
A lot of information.
It's a lot of information.
Don't hesitate to email us. So, all right.
Yeah. Thank you so much, James.
Thank you, everybody. Bye. I'm going to disconnect right now.
Have a great night. All right. Bye-bye.
Bye.